Hey guys, welcome back to Watch Trading Academy. Today we're going to answer this very basic question. Why are watches good investment? Now, if you've been following me on YouTube, then you understand that I teach people basically how to buy, trade, and sell luxury timepieces, and that enables them to make quite a bit of money. The average trader makes 10 to 12% a month, and that's pretty impressive, especially when you can start with as little as $1,500, access to a post office, and a computer. So pretty exciting to know that these types of investments exist out there, but then let's talk specifically about what makes them good investments, because watches specifically, and the word investments are meant to go up and to go down. But when I judge or look at an investment, now I've been known for being basically the king of alternative asset investing, something I've done since 2005. I had a firm that did that for quite some time in that era as well. And so I've been teaching online now for about over 10 years, since 2008, teaching people how to get in alternative assets with cars, with exotic car hacks. That's my other channel if you haven't checked that out. And then of course with Watch Trading Academy, my entire platform that exists for both of these, exotic car hacks and watchtradingacademy.com, which you can visit. But the point that I'm trying to make here is let's talk specifically about why watches are actually good investments, what makes them good investments as a whole, specifically, and how does that all work. So in order to do that, we have to understand two key things. First off, the word utility, and then the next word is supply and demand, which is basic economics, right? So just like great cars, not all cars are created equal, and not all watches are created equal. So there's the whole concept of investing in alternative assets is to actually do and understand the word utility. The benefit of that is that, let's say, for example, one of the reasons why I was never a fan of Bitcoin, because it looked like a penny stock to me, like a lot of pump and dumps, lack of regulation, a lot of problems. I looked at that and I said, okay, as a vehicle, it's a very dangerous one. And while it was disguised as a vehicle of utility, and it could have utility from a transactional standpoint, it just didn't make sense at the time, because the hype in purchasing it was not based on its utility, it was based just on hype. So it didn't really make sense. The other part comes to talking about how utility impacts other things. So let's take an example, okay? Let's say, for example, we had Beanie Babies. Remember those things? So for a long time, Beanie Babies were like the craze that was going to go up. So this is a good example of something that had no utility. Beanie Baby was a plushed animal, but because of its age, people believed it to be an investment. It was no different than a tulip and all the crap that you could say or label through the years as that have come as an investment. So why was a Beanie Baby basically didn't have any utility? Well, it's a flushed animal. Like a plushed animal would take probably $3 to make. So the cost of the asset is $3, right? But its value is basically like unlimited. So some Beanie Babies were selling for like 100 grand. So I want you to understand that. When the utility is only $3 and the value is 100, there's a lot of fluff. This is what we call fluff here, right? Now here's the other part. There was really nothing that made it, like there was no engineer or anything in the utility, so there was a lot of fluff. Like, because basically you're buying something you could go to Asia and duplicate for like $3. So it didn't make sense why this was going to be worth $100,000. It just didn't really make any sense at all. Now, to some people it did, because what happens is when you're buying here at $10, $200, $10,000, $30,000, $80,000, you're only buying in the hopes that this goes up. Nobody in their right mind would have bought a $100,000 Beanie Baby if they believed they would go to $3. They did it because they thought this would continue. So the last person to hold the asset is basically done, right? And in that case, it's an asset for the moment, but it's a temporary asset. So it doesn't have utility, so it's very, very dangerous. On the other hand, let's take a look and understand the utility of a car. Like if you, for example, own a Ferrari, and that Ferrari goes from 100,000 to 80,000, it has depreciation or something happens, well, it still holds the same utility. There is a cost, as an example, if the Ferrari has a cost of 220K, on average it's about 50 cents of that, so it costs about 110K to produce So you know that this is what I consider in my course, what I teach, called the bottom cash value. This is basically the bottom cash value of the item. It's the lowest cost of the utility itself, which in this case of a Ferrari would have been about 50 cents on the dollar. So it's about $110,000 is the utility of it. So where this becomes interesting in the utility is that something with real utility and real utility that has been recognized by the masses for at least 10 consecutive years, right, means that it forms what we call a bottom cash value and retains that bottom cash value over time because of something here called supply and demand, which leads to liquidity. When an asset has liquidity, right, it means that it has a market and people are trading this asset on an ongoing basis. When they have done this for 10 years, it basically becomes known, it goes from utility to an asset. So it becomes basically traded on a continuous basis at least 10 years, and it creates this model. And this is very, very important to understand. So the marketplace exists around it, sectors come around that build around it, there are dealers around it, so on and so forth. And supply and demand then makes the case for what we consider to be price. This is basic economics. Some of you are like, why the hell are you telling me this? I'm just teaching you because most people don't necessarily know this, so they don't understand that. So this model basically allows price to be dictated by the supply and demand, but it's no longer a problem like a Beanie Baby where liquidity completely leaves the market and nobody's playing anymore. So the thing with cars and watches is that when you're at 110K, and the market goes up to like 200K, and the market comes back down to 150K, and then goes up to 200K, it's dictated by supply and demand. It's not, liquidity has not left the market. There are customers here, customers here, customers here, customers here. And there's always a customer at a different value, and it's a different customer that pays a different amount based on the supply and demand. But the liquidity is always in the market. Now, if you look at watches and cars historically for the last 20 years, it has always had liquidity, and it has always been driven by supply and demand. And that is how we can basically gauge the fact that the utility factor of the watch, the cost basis, the time, the craftsmanship, the precious metal, and everything that goes with it has a significant cost that is greater than usually 30% of basically the final price. And if that's the case, that means liquidity is always existent at the cost of utility, which is 30 cents or above. So because of the utility the liquidity not coming so close to zero, it always keeps an active, engaged market. And this is why watches and specific exotic cars and specific watches too make for not only good investments, but make for a good enough utility vehicle to basically be traded on an ongoing basis. Plus, I would argue, when the markets fall 70-80% or your Bitcoin goes from $80,000 to like $5,000, it means you still look at a piece of paper on the computer and you want to punch the computer. But at the end of the day, there's a guy that paid $3 million for a picture of a monkey on his phone. I paid $3 million for my Bugatti. Even in worst case scenario, I'm driving a Bugatti, he's holding a picture of a monkey on his phone. Let that go through your head. Make sure you like, subscribe, turn on notifications, and I'll catch you next time on another video for Watch Trading Academy. And take the training.